So we're going to continue our lesson on chapter 9, accounts of purchases and cash payments. And so what we're going to do is we're going to move forward into our 9.2 section. And that's going to be accounting for merchandise purchases. So how we record this information. Okay. And so we're going to skip down a couple of slides because we already discussed these. So here we're on slide 7 and 9.2, accounting for merchandise purchasing. So that's where we're at. And so what is merchandise purchasing? It's measuring inventory, right? That's the key thing is keeping track of, as you make the purchases, what's happening with your inventory. And as you measure your inventory, you'll know how you need to make these purchases so you don't spend excess amount of money on unnecessary product that's not selling at a pace that you know that is financially beneficial. So you'll order the correct amount based off of how your inventory is moving. And also sometimes you can make a change as you might notice that companies eliminate products that's based off of that tracking of inventory. So measure inventory. A list of assets usually contain the value of an individual item is called inventory. Okay, so they have value because you're using your currency in exchange to gain some type of good so that you can resell to produce something out of it to produce a alternate product with these goods that then the consumer will want to buy. The goods a business has on hand for sale is called merchandise inventory. Okay, so this is the goods on hand, keeping on hand. Okay, perpetual inventory method. This one here, the key thing it talks about, it's a computerized accounting system. So inventory determined by keeping continuous records, increases, decreases, and balance on hand of each item of a merchandise. Businesses that use perpetual inventory method usually have computerized accounting systems. So the easiest thing I try to say, and it's not 100%, but think of like the grocery store, okay, or think of like Lowe's. So what do you do when you go there, right? Or you put even Home Depot. So ideally, what happens is at these stores is as the products come in, they do come with a manifest, and intently there's supposed to be so much of these items. Well, there's never 100%, and so as the items are scanned in, they're counted. And what happens is then as the items come in, they put it on a backroom shelf and then work their way to the floor. Well, when they're scanned in off the truck, it's verified to make sure that the item made it there. They scan it in. If it didn't, they create an audit stating that the product didn't arrive. So then figure out what happened. And then the number of product that arrived is added into is increased. Okay, and so they just scan. So if it's a whole box, they scan the box barcode and it's gonna, add that amount of product that's in that box. Okay, it's computerized. Well, what happens is that as you purchase the good and you scan it out of the store, it's going to delete or decrease the amount of product that's on hand. And so the computer, as you're scanning it out and as they're scanning it in, is going to keep track of the increase and decreases. Then what's going to happen is, as we said, you need to use this so you need to know what products are moving to know how to order. that information is going to be sent to whoever is in charge of doing the purchases to determine if an increase or decrease of purchasing that product needs to occur. Now, this is very helpful, especially during seasonal times, if you're selling seasonal goods, to know what seasonal items have a higher percentage rate of being successful, and making sure that you order a sufficient amount of the product. Okay, so that's why computerized accounting systems exist, to help with some of those factors. Okay, and so you see them at the store all the time, especially these larger brand stores, because you see them as you're scanning out, they've been scanned in. Okay, and that's going to allow them to know. That's why if you go to different stores around the Houston area, just in general, you'll find that some stores have certain items that other stores don't have. Why? Because they use geographic and demographics also as a factor of the inventory. Okay, and so that's why computerized accounting is so important, because it helps them to keep track of that data instantaneously as it's happening. Okay, so then you have your other style of, which is considered periodic inventory method. So this one here is kind of what we touched on a little bit. This one here is what you're gonna think of, actually, think of groceries. So like groceries, fruit, okay, or nuts and bolts, okay. And what I mean by that is, that looks like an H, that's supposed to be LT. Is a merchandise inventory evaluated at the end of the fiscal period. And periodic inventory is conducted by counting. Okay, this is why I say count. Why I say fruits and I didn't put vegetables, but fruits and vegetables, because it's by counting and weighing or measuring the items of merchandise on hand. Is a physical inventory. So periodic is physical, and so it's there to go and make the adjustments. Okay, a lot of your retail stores will do both. Most, I know Target for sure does. Now they do it differently. I think Target, from where I does it quarterly. I think Walmart does it like annually or something like that. But periodic, and the reason I say fruits and vegetables, nuts and bolts, is because it's tedious. It's all you're going through an individual and counting every single one. And so, do you think they really go and count every single fruit that comes in all the time? No. What they're going to do is they're going to say there's a case here, there's supposed to be this many, and then what they do is they're going to count, well, we're supposed to get this many cases. Now, at the end of the month, at the end of the day, there's only this many cases, so we sold this many cases. That's the periodic. Okay, it's slightly different. Okay, some companies use this as they just do once a month because it's physically done. It's time consuming that they don't track. They just say, we know we need to purchase a box of bolts that has 2,000 bolts in it, and and that should get us through 2 months. And then what we'll do is at the end of the month, we'll count them and determine how many more bolts we need to purchase next month. Okay, because they go and physically count. Okay, 1, 2, 3, 4, 5, or weigh it. Whatever. Let's just weigh it. So, okay, well, it's 10 pounds. Each bolt weighs half a pound, so we only got 20 bolts left, roughly. Okay, whatever method they use, they're periodically trying to figure out the quantity that they have. Okay, so it takes a physical effort. It's not, scan. Computer is adjusting. So I can tell you, when I said Target uses both methods. So what happens is periodically, every week, they'll do scan, or every day that you have a team that goes through that goes out and they scan items that are considered lows for the day. And during that time, they'll use that time to periodically count the items also to make the adjustments. And because they'll say, oh, well, we have no product on shelf. The shelf's out. It's in the back room. they'll pull it from the back room, and then notice in the back room there's supposed to be 2 products and there's 0. Or they get back there and the one product's damaged. They're like, oh, well, we can't put this on the floor because it's cracked. So then, we need to correct that and make it damaged. Okay. And so periodically they do that. And I know they then send a team out for a day or so to periodically go through all the inventory and count it. Okay, and that's to help with adjusting so they can make an accurate adjustment of where the product has gone. Okay, so these are your different styles. So just know that perpetual inventory method is computer-based, like automation, and periodic is your manual counting. The amount a business pays for goods it purchased to sell is cost of merchandise. That's very important. Okay, so this is not supplies, as in supplies that we purchase for, like, say, the computer, unless we're using that computer or something for products that we're producing. It's not the same thing. So, for example, other items bought such as store supplies are recorded in. So, if I bought a shelf, it wouldn't be under cost of merchandise. That'd be supplies, right? Completely different. Items statement of merchandise business place purchases in this section titled cost of goods separate from other expenses. So you're going to have a purchase account in your expense section called purchases, okay? And that's going to be a cost of good, and it's going to be an expense. So it's going to affect, right, our owner's equity account. Cost of goods section includes all costs necessary to make an item of merchandise available for sale. Freight charges paid to ship items to the merchandising business, okay? So if you pay to get it to you, okay, not to ship it out to the customer, this is to you, okay? So if I purchase a good and had freight, I'm going to add that into my cost of good because that's going to increase my price of good. And you might be like, what are you talking about? Okay, so if you're going to have your cost of good, right? And say it's $500. Okay, that's a horrible 5. Then you're going to have your freight. How did I put G? Cost of good. Oh well. And say they charge us $100. Okay, so we have to have a total cost of good, which is going to be $600. Okay, so if we purchased 100 items, okay, then truthfully, our cost of good, if we're just thinking cost of good, would be $5. But really, in reality, because we have to factor, we have to recover this $100 also in shipping costs. Truthfully, it's $6. So when we're doing the pricing, then we know that actually our inventory per item is $6, and then we need to make sure we price for that margin of profit to include the cost of that $100 for shipping. Okay, and so that would be like, oh, okay, well, it costs us $4 to ship to customer, right? We'll put ship to customer. So we can sell it for $11. Okay. Well, if we didn't include the $100 freight cost of good, we'd be at what? We would be at $9, right? 5 and 4 for shipped cost of good to customer, or shipping cost to customers for our cost is what we thought was 9, then we have a $2 potential profit margin. Okay, I'll put PM, profit margin. Well, in reality, because we didn't factor that in, it's really 6 to 10. And so reality only have a profit margin of $1, which means we're only profiting half as much as we thought. So then when we go to figure out all the expenses, that we notice that we actually short ourselves half as much profit potential because we weren't calculating our expenses correct. Okay, so it's very important to understand that you also have to factor in your freight costs. For businesses using perpetual accounting methods, the cost of merchandise is recorded in the merchandise inventory account until the goods are sold. When goods are sold, the cost of merchandise is removed from the merchandise inventory and recorded in the accounts of cost of goods section. And so if you notice, purchase is a debit increase and credit decrease. Okay. So here's an example I pulled from my company 2 years ago. So here was, I purchased from Macy's liquidation. This is the date. Right here. And this right here is how much it would cost. So if you notice here, when I typed in Macy's, because I was trying to show the whole list, but when I type in Macy's, it's going to go from the cash, the expense account. So when we're using this is in Wave when we're recording it, right? And my vendor is Macy's. When I paid it out, when we're drawing from my cash on hand account, how I have it, this is how I had it set up, was just a cash on hand account. And withdrew the cash from here to pay for this. So it wasn't not accounts payable, it was just pay. I had to pay it immediately. So here's your expense, and so this product will now, because it's a cost of good product, will now be in the Macy's cost of good account, as I have it labeled there. And so this is how you would see it, like in Wave or QuickBooks. Ordering merchandise. A form requesting the purchase of merchandise is called a requisition. A form requesting that a vendor sell merchandise to a business is called a purchase order. So right here, this is your purchase order. Okay, so here you're sending a request for the vendor to sell merchandise to you, and these are prices that have been determined, and here's the items, and here's a total, and here's the price. The purchase order lists the number, description, quantity, and unit price for each item ordered. The vendor uses the purchase order to approve the sale and process the order. So these prices are prices that tend to be agreed by both the seller and buyer. Okay? And this is a quantity also. Now, if this quantity is not, it cannot be fulfilled by the seller, then the purchase order needs to be canceled and corrected for what the seller can agree upon. This is basically telling the seller, like, I want this quantity at this price, so I'm going to spend this much money, no more. And if you approve it, that's what I'm going to send you a check for. Okay? The accounting procedures taught in Part 1 provided an effective system for small businesses with a limited number of transactions. Increased efficiency, separate journals were developed to record transactions impacting similar accounts. A journal used to record only one kind of transaction is called a special account. Business typically use 5 journals. So there's a special journal for purchasing on merchandise on accounts, a special payment journal, sales journal, cash receipt journal, and general journal for all our transactions. So this is just some of the special journals that are used. A transaction which the item purchased or to be paid later is called a purchase on account. Purchase journal is a special journal used to record only purchases on merchandise on account. So this is the same as think of like accounts payable. Okay, so slightly different. It's per purchases, right? So that are cost of goods. Okay, so it's slightly different. A purchase journal is a special journal used to record only purchases of merchandise on account. Each purchase of merchandise on account transaction is recorded on one line of the purchase journal. The amount column has 2 account titles and its heading: purchase debits and account payable credits. So when a buyer sells merchandise to a buyer, the vendor prepares an invoice showing what has been sold. Okay, so this is received, the date, and document. Invoice used as a source document for recording a purchase on account transaction is a purchase invoice. Agreement between a buyer and seller about payment for merchandise is also called term of sale. So you right here, you'll see terms N/30. This is your N terms. That you have 30 days, the term of sale. Therefore, payment must be received by the vendor by December 4th, date which in the invoice must be paid is called the due date. So here you have shipping method, shipping date, delivery date, expected based off of shipping times. Then they give them a 30-day term to pay. And here's a list of the items that are being purchased. And you have the company, the ship to address, the recording of the invoice information, and document number. Okay, so how do we record this? So this is your purchase journal. And so a purchase on account transaction increases the amount owed to the vendor. This transaction increases the purchase balance, increases the accounts payable balance. Okay. So because purchase is increased by a debit, is debited for 1,800, therefore accounts payable is credited for 1,082 to show an increase in this liability account. So you're going to record the date, the purchasing company. Here's the number, purchase invoice number, and then here is the purchase on accounts payable for credit. How much they're going to be accounts payable. Okay, so if we end here and we move over to the practice, for 9.2, and Singe for accounting. So we have the date, okay, October 2nd, and we have a purchase from Pacific Supply. And it says, use October for the current year, utilize the transaction for Golden Fabrics on page 10 of the purchase journal. Purchase invoices are abbreviated as P. No P is needed in the purchase number column. So we don't need the P for P162. We just need 162. And then we're going to put 3252 in. And then we're going to come down here to the 7th, and we're going to put Coastal Company. And we're going to put 163 and 532. And then we're going to put the 11th and mistype. Yeah, man. Designs. 64. 866. And that will be it. So that is chapter 9, section 2, which is referring to purchases and how to record them. On the accounts of merchandise purchases.